We start today's market talk when market participants are uncertain, fearful, anxious. The next period returns are above normal. This is generally seen that sentiment is a contraindicator, whether in markets or in specific themes. And most thematic funds crowd in usually just before the peak in that theme. Market outlook. It was a week of nervousness in the markets. Worse than expected US unemployment data triggered expectations of a 50 basis point rate cut in US. Same time, Japanese central bank raised its policy rate and signaled more in the offing. It led to sharp appreciation of yen and unwinding of the yen carry trade. Now, subsequently, it took positive commentary from Bank of Japan and the solace of the jobless claims report to calm the markets. So the initial jobless claims came lower than expected, and then Bank of Japan made some cool noises to calm the markets. And also the markets which are generally priced for perfection tend to panic very quickly nowadays. So probability of 50 basis point rate cut in September has reduced and yen has weakened and the markets ended the week very calm. US services PMI also came strong, so it indicated that there was no requirement of a panicky 50 basis point rate cut. Now, also this week we had RBI policy. Now, with no action from RBI, the outlook for bond yields still remains positive because if you have observed, the GSEC yields have softened to below 7%, and the market is pricing in a 25 basis point rate cut sometime later in this year. It is also due to favorable demand supply dynamics, contained government borrowing, and inclusion of government bonds in JP Morgan government bond index has created higher demand and led to fall in the bond yields. No matter how loved a category is, just pouring money cannot keep prices high. Right now, though there is no significant risk as such, but some of the valuations have become very expensive. So ultimately, it is the fundamentals that drive prices. A surge in investment in any theme is generally a warning sign, and we have seen this with various sectors. Right now, there are several macro risks to India. GDP growth is largely driven by government spending, private consumption is lagging, etc. The only lasting impact of global geopolitical events, if at all, are typically on oil and gold. So, in most cases, the market forgets about geopolitical problems in 6 months to a year. Hence, because of the kind of inclusive markets we have in India, uh, the any event which takes place all over the world impacts us only in terms of prices of oil and gold, which has some kind of which is now even having reducing impact on the Indian economy. While talking about sectors, manufacturing is still at 13 to 13.5% of GDP. There is some weakness in the rural sector, and there is talk about unemployment, and exports are declining. So it is time to be cautious with small and micro caps and new IPOs which are not supported by earnings. As technology adoption continues to grow globally, the spending on tech, even if postponed, will eventually pick up. IT has gone through a slowdown and there is a pickup in their performance. Enthusiasm in power utility sector seems to be overblown. Uh, and the current valuation don't seem to be justified. Among the sectors which look slightly better priced are autos and auto ancillaries, capital goods, engineering, chemicals, which have some kind of potential. And it is time to book profits from frothier part of the market and shift to steadier portfolio, especially those stocks which have run up too much on expectations of good future earnings, but presently the earnings are below estimates. Talking about the basic statistics for this week, both the headline indices generally corrected around 1.5%, Bank Nifty correcting slightly more. Gold was slightly up, silver was down, crude oil and natural gas were up 5 and 8% due to upcoming winters. Uh, Dollar index came down a bit. USD INR declined, and now it is touching 84. So the rupee is becoming weaker as compared to US dollar. The 10-year bond yields came down slightly. Uh, NSE market cap, because of the correction, also came down by 1.5%. Market-wide position limit is up around 3.59%, which is high, and which shows that uh, people are taking positions which will bring in price volatility. Uh, Dow Jones, Nasdaq, S&P 500 were generally flat to negative. Now coming to US, sentiment swung from depth of negativity at the beginning to peak of positivity at the end, all because of certain data points. All benchmark indices closed flat for the week. CBOE volatility index came down to 20 odd from 50 to 60 levels it had gone to earlier. So if you see this US 10-year yield on the weekly charts, it is making lower lows. It went down to around 3.7 level and then got corrected a bit, went up a bit. Basically, due to the reason it corrected was because there was expectations of an emergency rate cut because of fear of recession. But subsequent numbers showed that there is not much of services data was strong and jobless claims were not that weak. Hence, there was no reason for an emergency rate cut, and then the bond yields rebounded. US dollar index also had corrected to 102 level and then bounced back to around 103 level. So this has to be bound. So the basically two parameters, the US 10-year yield and dollar index has to be watched for the future trajectory of the economy, of the US economy. Brent crude prices rebounded from this downward trend line support and went back to around 79.25 levels. Gold corrected because there was a lack of enthusiasm in all assets, but then quickly bounced back. And with the rate cuts expected, it is expected to do well only. Copper corrected. There is no super cycle in copper. It is now below the 50 EMA. And it is tending to correct because there is more inventory now. Earlier, there was a shortage of inventory. Now there is adequate amount of inventory, and hence the copper prices are coming down. Nasdaq came down, corrected. There's a weekly chart. So if you see here, it corrected to its 50 EMA on the weekly chart below the trend, below the rising trend line, and is bounced back. But the 20 EMA will provide a resistance. So we'll have to see subsequent week for its future performance. India VIX had gone to 22, 23 odd levels, then came down drastically and has come down to around 14 levels. So the days there is a gap up. If a gap up happens, the VIX declines more. Hence, the option buyers are always at loss because uh, because of this the premiums decline. Government bond yields, as I brought out, have corrected and have come down to 6.88 level, and the trajectory is lower as the trend is lower. Nifty, if you see, made a green or a bullish hammer, so which indicates there is likelihood of a trend change as such, but there is a big gap here which has to be filled. It it had gone nearly close to, will show you on the daily chart. So it went down below 24,000 level and tested the 50 EMA, went below slightly on Monday, but it bounced back. So it had four red candles throughout the week and one doji. So there is no clear sign as to which direction it is going. It tried to go above the 20 EMA on Friday, but faced some resistance at 20 EMA at around 24,400. So this right now it is stuck in this zone of 24,000 to 24,400. It is above the high of uh, the election day high. So it is still in positive territory and momentum is good. So this levels has to be crossed. Now let's see the 30 minutes chart. This gap from 24,350 to 24,686, which was the low here, is the gap which was made. Now this gap has to be filled very quickly for any momentum to come. Otherwise, this will be remain a sideways market. So this has to be crossed. So if you see the RSI, it became on 30 minutes chart, it became oversold and then it recovered. So this has to be seen right now. So moment it becomes oversold, it recovers very quickly, as you have seen throughout the week. And even the gap ups which were there throughout the week were sold into, and then every day there was to be a gap up, and then it had been sold as such. Only the day the gap up was not sold was Friday as such. So one has to be slightly careful. Nifty Bank made a bearish hammer on weekly chart. So this has to be watched. And on weekly charts also, it went below this 20 EMA, which is there at 50,000 odd level. So this is an index which is weak. Now on daily charts, if you see, it is below the election day high and it tested the 100 EMA number of times during the week, 4 times exactly, and was able to take support there at around 49,860 level. So this level has to be watched. And on the upper level, 50,800, which is the 880, which is the 20 EMA. So it is again in a zone. If it breaks above this level, then only there would be some momentum. Otherwise, it will, if it keeps knocking this support, 100 EMA support number of times, then it over a period of time, it breaks. Now, among the stocks which impact the indices didn't correct too much was also because of the strength in HDFC Bank, which took support at its 50 MA at around 1600 odd levels, 1610 levels, and then bounced back from there. So this is because of there is some MSCI rebalancing. Money is expected to come, so that it's coming in small parts, and that is keeping this stock slightly bullish. But it will face resistance at this 670, 1670, 1680 levels, where there's a gap is there up to 1725. So for a sustainable strength, it has to cross above these levels. Reliance has broken on the weekly chart, broken below the 20 EMA, so of 2960 odd. So now it is looking weak. So if it has to trade above this 2960 level for some strength, otherwise this will remain weak. The stock which was in momentum, and if you see on the weekly chart, it has always been above RSI of 70 is Trent. And after good results, it broke out and now it has made a fresh all-time high. And if you see the chart, it has constantly been above the 20 EMA and is doing reasonably well with good growth and good profit margins. PSU banks uh, since the election day have been weak and they are making lower highs and lower lows, and it has closed below the 20 EMA on weekly charts. So this is one sector where profit booking is taking place. Midcap index has recovered from the lows last week and made a strongish kind of a green candle. So this has to go above the last high of 58,000 plus to show some strength. Otherwise, it will remain range bound. But since it is trading above the election day high, it is showing some strength. Same with small cap index, similar chart. It has to, for strength, it has to close up and make a fresh high, which the trend is there. Right now, still the trend is of higher highs and higher lows. So there's not much of worry. We'll cover three stocks today. First is Cummins India. The product range of this company primarily includes diesel engines, generator sets from 15 kVA to 200 kVA for various power and industrial uses. Cummins also manufactures alternators, digital controls, transfer switches, etc. It's a leader with a 40% market share in the diesel engine gensets industry. It has strong presence in high value and high margin HHP gensets. HHP is high horsepower gensets. Company's domestic businesses is divided into power generation, industrial and distribution segments, uh, contributing 80% of its sales. Exports contribute around 20% to sales. The company exports to over 40 countries comprising the Middle East and Africa. For FY 2025, the management has maintained its guidance of revenue growth of 2x of GDP, roughly around 16-17%. Moreover, with the sale of higher value CPCB4 gensets, margins will improve. It is well positioned for transition to CPCB4. CPCB is Central Pollution Control Board plus norms with favorable long-term implication in terms of revenue and profitability. About 40% of the sales are from CPCB4 engines and is expected to reach 75%. The good part is that the market is accepting the higher prices of CPCB4 products, so which is strong. In addition, it would benefit from broad-based demand for data centers, healthcare, infrastructure, and real estate. Operating margins came at 20.3% versus 15.4% in the same quarter of last year. So they were up. Net profit was up 33% year on year to 420 crore, led by strong operating performance. Domestic sales grew by 12% to 1873 crore. Exports declined 22% year on year, leading the revenue to grow marginally by 4%. Sale of CPCB2 genset is only allowed till June. So whole market will now transition to CPCB4 products over a period of time. So this should benefit from there. Expect a 16 to 17% CAGR in revenue, PAT over FY 24-27 and ROE, ROC of 28 to 36%. So if you see their quarterly results, the net sales for year on year were only up 4.3% and slightly down Q on Q because of lower exports. The good part was that the raw material cost and staff cost decreased. Hence, the PAT was higher by around 33% because the margins improved. And that margins you can see here. So operating margins were up 486 basis points. So from 15 odd percent, it went to 20%. And PAT was also up around 33% because of better margins, even if the revenues are not growing. So if the revenues also start growing well, as the management has indicated, this should perform very well. So let's see the valuations. Operating margins are expected to sustain above 20%. It is expected to do an EPS of around 81, 82 in FY26 with the EPS growth of around 15 to 20% over the next 3 years. And ROE, ROC is going to be strong. So at 80 odd EPS, at 50 times, it can easily trade at 4,000 levels, it is heading towards that level. But beyond that, it will be difficult for it to go up. See the charts, it has taken support at 100 EMA. So daily chart. So if you see, it has constantly taken support at 100 EMA over a period of time. And so it has bounced back from there. So every time there is a dip to this 100 EMA level, that is the opportunity to enter this stock. Next stock is Lupin. It maintains its leadership position, ranked 3 in both US generic market and US total market by prescriptions. It has been gaining strong market margin expansion on the back of restructuring in the US and intends to enhance it further with the help of launching of complex generics and specialty products in respiratory, injectables, and biosimilar segments. It is expected to see launch of its key product, Spiriva, in Q2 FY24. Now, Spiriva is basically to treat asthma. Additionally, it has added 1,300 sales representatives in India. Also, the company has been seen improved traction for diabetes, cardiology, and respiratory product sales in India. 3 out of 5 of its plants, which are going through regulatory action, are compliant with the US FDA norm. A revenue growth of 10% in FY25. EBITDA margin guidance of 23 to 24% for FY25. It expects FY26 to be healthier than FY25. Company has guided for continued improvement in earnings on account of improved product mix, strong lineup of product launches, and lower taxes over the short to medium term. It envisages US constant currency sales to increase from US $200 million to $230 million in FY25 and inch up to $250 million quarterly run rate from FY26, driven by no immediate competition expected in Spiriva. Expected launch of Mirabegron. Mirabegron is basically for overactive bladder. Launch of peptide-based products like liraglutide, which is basically used for diabetes. Launch of ophthalmic products like glucagon, which is basically to regulate blood sugar. High value, low competitor products like tolvaptan, Cylint, and loteprednol and risperidone consta. So if you see, tolvaptan is basically for low level of salt in blood. Cylint is for oral contraceptive. Loteprednol is inflammation of the eye, and risperidone is for schizophrenia and bipolar disorder. Its respiratory portfolio, which is a key segment, is albuterol. Market share is 23.4%. Albuterol is for asthma, and AR formoterol market share is 28%, which is for bronchoconstriction. The new product pipeline is expected to aid in increasing the EBITDA margins to around 23-24% in line with peers. Company has filed one ANDA. ANDA is abbreviated new drug application, a request to FDA to sell a generic version of a branded drug. Received 12 ANDA approvals from US FDA and launched 6 products in the quarter in the USA. The company now has 161 generic products in the US. It is the 7th largest company in the Indian pharmaceutical market. Company is focused on complex generics such as inhalers in the respiratory segment and injectables to spur growth. Going forward, the company has healthy product pipeline of complex generics and specialty products, which constitute 70% of the product pipeline. Diagnostic businesses grew 160% year on year in FY24 with 40 labs under operation, serving 1.25 lakh plus patients per month. Now let's see the quarterly results. The total sales were up 16% year on year and 12% Q on Q. EBITDA was up 50% because of lower rise in expenditures as compared to sales. So better margins. PAT was up 77%. Interest cost was also lower. EBITDA percentage has improved. Now it is 17-18 level. It has come down to around 23-24%. And if this is maintained, then and if there is a growth, then you will see good growth in profits. Segmental revenue wise, North America and India are 2 of its biggest segment. Others are also doing well, but these 2, whether Q on Q or year on year, continue to do well and show good growth. So these are the segments to be watched for in formulations as such. It is expected to show a sales growth around 15 to 16% over the next 2 years, and operating margins as expected on 23-24% range. So it is due a adjusted EPS of around 84. So at around 2400, 2500 at 30p, it should be a decent level to hope for in next 1 year or so. and ROE, ROC have improved over a period of time. Let's see the chart. It after results, it has risen above this 1800 odd level, 1600, 1800 levels, and now it has reached 2100. So if you have to buy this stock, one has to buy it closer to the moving averages. Right now it has run up a lot, but every dip is a buying opportunity in this stock. It's slightly overbought also with RSI at 80. Last stock today is Raymond's. Revenue doubled year on year to 940 crore, led by strong performance in the real estate segment and the contribution from many precision products, which was acquired on March 24. Presently, the Raymond constitute uh, the real estate and the engineering business, while lifestyle business, which is yet to be listed, has been separated. EBITDA margin reported over twofold growth to 100 crore as consolidated EBITDA margins improved by 100 basis points. Growth in adjusted PAT was constrained at 26% due to higher interest costs, leading to 350 basis point decline in PAT margins. Real estate segment booking jumped 85% year on year to 610 crore, uh, down 23% Q on Q, but you can't see them Q on Q. Led by launch of two phases in Thane, addressed by GS Season 2 and Invictus, and its first joint development project in Bandra. Booking from Thane land parcel remained stable at over 400 crore for the fourth straight quarter. Collections more than double year on year to 470 crore. It expects a CAGR of 35% in pre-sales over FY 24-26 to 4,000 crore. Engineering segment revenue doubled to 420 crore, driven by 220 crore contribution from MPPL. Excluding MPPL, engineering business revenue declined. With the planned demerger of its real estate and engineering businesses, which is going to take place in another 1.5 years, the company led by a professional management now can carve out an individual growth strategy for both its businesses separately. Lifestyle segment reported subdued performance because of fewer marriage date. Branded textile 45% revenue contribution declined 18%. So let's see the quarterly performance. The revenues was up 98% and EBITDA was up around 121%, nearly 100 crores EBITDA. Margins are also, EBITDA margins were also up, but as the finance cost was higher, the profit margins declined. But this is normal. So if you see real estate revenues is year on year has improved or has become 2x, double, though margins have declined a bit, but they would be variable. Uh, Engineering revenue is up, if you see here, uh, in terms of roughly around 420 crore, and margins are slightly down, but it's again on an upward trajectory. So if you see the valuation, this is one of the brokerages has valued it. They have valued the real estate business at 1900 rupees and engineering at 410. So total combined consolidated value is on 42310. It's around right now it's at around 2030. So another 18-19% upside is expected from here. This is the lifestyle business performance. Consists of four parts: branded textile, branded apparel, garmenting, and B2B shirting. All of them declined in the last quarter and year on year also. But with this onset of marriage season, etc., this is expected to bounce back. So Raymond lifestyle revenue declined 8% year on year, 6% Q on Q, and margins were lower. But keep this in this thing with the upcoming season, etc. Future in terms of the second half is always good for this stock. Now, if you see the chart, they demerged the business, so it came down to this 1900 levels, and it has been in these levels since this level. So this is a decent level to accumulate this stock with all the ups and downs of this market. This has not gone below this 1900 level. So it is consolidating and should rise from here. I have finished. We will take questions now.